Business. Hi, this is Brett Sykes, the Right Brain Business Attorney, and today we're talking about setting up crypto asset hedge funds. So something that at this time is increasingly popular. So this is a one-on-one about hedge fund setup, just to help you understand the lay of the land, because it's very confusing. There's regulation and securities law and pieces that intersect and can very easily get your head turned around. So I'm going to try and demystify some of that and just give you a broad overview of hedge fund setup generally, and then a few specifics that make crypto asset hedge funds a little bit different than some other types of hedge funds. So I'm a corporate attorney, and part of my practice is around securities offerings and fund work. So fund work has a heavy securities offering piece, which we'll get into in a minute. And so hedge funds, private equity funds, real estate funds, that's part of what I do. And I'm seeing a lot of activity, and I've had a number of clients in the crypto space, including setting up crypto asset hedge funds. So those are fundamentally a lot like other hedge funds in certain ways, and we'll get into that. They're a little bit easier depending on what you're trading. But this is something that in the post-ICO days, after that sort of cooled, we're still seeing a lot of activity around setting these up and people wanting to trade tokens and raise money to do it. So any fund, so it could be a real estate fund, it could be a private equity fund, it could be a crypto asset fund, a venture capital fund. Think about in three broad separate projects. Okay, let's think about it in three different phases or aspects to the project. One is the fund and founder formation piece. So that's setting up the actual entities, choosing where they're going to be set up, what type of entities we're going to use, figuring out the deal among the founders, the principals, the sponsors, whatever you want to, promoters, whatever you want to call those, the people who are making the fund happen, the interaction between the entities we set up. So usually there will be a general partner and a limited partnership. The general partner manages the limited partnership, which is the fund. It's more and more common to see two LLCs. So the fund is an LLC and the manager of that LLC is another LLC. So, but fundamentally, you've got two different entities. One is the fund, and one is the manager or the general partner. Now, sometimes there's a reason to have a third entity, an investment manager. There is in Texas, for example, because it's tax-driven. It has to do with franchise tax, but you don't have that in every state. It just depends on where you are, usually. So, but you're always going to have two entities. The partnership, the fund entity, is often a Delaware entity. Doesn't have to be. We're not going to get into that. But feel free to call me if you have questions about that. We can talk about why you would do that and not do that. But you've got your two entities, you've got your deal among the founders, you've got their deal to the investors and how the partnership, how the fund all works. That I call founder and formation. And that exists in any business setup. I mean, a fund is no different. So when a technology startup comes to me, we're doing a formation and founder piece. It's simpler in ways, and it's more common in more lawyers who do it, but that piece exists in almost any kind of initial business relationship creation. Then you have a piece that's a securities offering. And this, be very careful to distinguish this piece from the next one, which is the regulation around managing the money. So you've got a piece that, think of the securities offering to get the money. So the fund issues interests in it. Partnership interests, or if the fund is an LLC, membership interests in return for capital contributions. So those limited partners in the fund make capital contributions, they get an interest in the fund. That's a securities offering. So you have issued a security, which you're getting money, and there's an expectation of profit from the investor off your efforts. That's how we test at 70, 80 years old. That's clearly there. So you have to figure out how do you do that? And there's only two ways to do that in the United States. One is to register the securities with the SEC, which is time-consuming and expensive. Another is to find available exemptions. The most common fund exemption we use is 506B. It's Regulation D 506B. It's considered a safe harbor for a private offering. And if you don't take in accredited investors, if you only take in accredited investors, which you absolutely should only take in them or higher, and we'll get to that in a minute. There's a different standard called the qualified client that you may actually need to be taking them in for a different purpose, for that third piece, the money management piece. But again, stay in the second bucket here. We had founder formation, now we're on securities offering to get the money. 506B is the most common one we use, and it's a very easy hoops to jump through to get the benefit of the safe harbor if you only take money from accredited investors. There are no specific disclosure requirements if there's no non-accredited investors, although it's very common that we put together in Fund World a private placement memorandum, which is a 50 or 60 or something page document that's quasi-business and legal and lays out how everything's going to work, the kind of people you're taking, or investors you're taking money from, their rights, their obligations, the risks, what you're going to invest in, things like that. So that's universally produced for in Fund World. Is it an actual requirement of 506B? It's not. But there's a reason you would want to do it. I mean, there's a few reasons. But that's all the securities offering piece. So you're jumping through a hoop in order not to register the interest that you're giving out. You're finding available exemptions from the SEC, and 506B is the most common one. And 506B is a federal exemption, but the securities that are issued pursuant to it are called covered securities. And what it means is the states can't impose their own obligations on the offering. You don't have to worry about fighting state by state by state exemptions. You have to do notice filings in each state, and it's a chance for the state to grab a couple dollars from you, but you don't have to worry about complying with every individual state, which makes it really a lot easier if you're casting a wide net and bringing in a lot of limited partners, and that's what most funds expect to do. The third piece is money management. So remember, that second piece is getting the money. The third is putting the money to work. Now, this differs depending whether you're a venture capital fund or a private equity fund, or in our case, a hedge fund, a crypto asset hedge fund. Now, crypto assets, the world's struggling to understand exactly what they are and how they should be regulated, but it's clear that the SEC is taking the position that just about every initial coin offering is a security. But things like Bitcoin and Ethereum and Litecoin, things that are coins that are well established, that are traded heavily on exchanges, that are flipped around the world, and have utility outside of the ICO context, when people are just they just want to get money and people are just buying a coin to flip it. There's really not utility usually. In this context, there's a lot. Bitcoin's a store of value. Ethereum is, Ether is something that you can build off of. It's becoming sort of the underlying kind of protocol, if you will, for smart legal contracts and things. Those things are pretty clearly, at least today, not considered securities. They're commodities, which means if that's all you're trading, and not just those three, there's others, but there's a universe of tokens or coins that if you're only buying those, you're a true crypto asset hedge fund, then you have very light regulation on the money management side. You do have to think about commodity pool issues, and the Commodity Futures Trading Commission, the CFTC, regulates those things. But if you only take money from accredited investors, there's really pretty easy exemptions there. There's not a lot of, it's not terribly difficult today to navigate that world. Now, if you want to start buying into other things, so other companies, if you could buy into ICOs, it's really hard right now to do, but other things that aren't crypto assets, that aren't commodities, they're clearly securities. So let's say, for example, there's a company it's a decentralized technology company, and they're raising money. It's just a private offering of securities. And you think that's within the thesis that you've laid out for investors, because you're not just trying to flip coins, you're also trying to get investment into some of the protocols and properties that are going to kind of run this decentralized universe, right? So let's say that's what you're doing. That's a security. So if you're taking in money and then you're going to buy securities, now you're in the world of registered investment advisors. Now, an investment advisor is someone who advises people. They're in the business of advising people on buying and selling in securities. So they're stockbrokers. They're most private equity fund managers, hedge fund managers who are trading in the markets, the public markets. They're buying and selling securities. So you're in registered investment advisor territory. So again, on this third piece, if all you're buying and selling is crypto assets, or to take it out of this context, if all you're buying and selling is actual real estate, then you're not buying and selling securities. So in those two contexts, those two types of funds, crypto assets in our case, that could keep you out of the registered investment advisor world. And it's nice to not be in that world, because that's a really mind-numbingly dense regulatory regime. And it's a kind of state-by-state thing. Now, private equity and venture capital funds have, over the years, developed very strong lobbies, and they have a lot of money. And there's something called a private fund advisor exemption that effectively makes their dealing with that regime pretty easy, relative to, say, just a straight-up normal hedge fund that's playing the public markets. And this is a state-by-state thing, and it's going to depend on a number of things. But first and foremost, where you're providing the advice from. Like, where's the seat of your primary office? Where are your co-founders? That's going to drive some of this. But you can assume, to take something away, that if you only trade the crypto assets, it's pretty easy. If you were to be a private equity or real estate or venture capital fund, also pretty easy for a bunch of reasons. But if you're going to be a hedge fund that trades securities, you're very likely going to have to only take in qualified clients. And so an accredited investor is someone who has a net worth, not including their primary residence, of at least $1 million, or made at least $200,000 each of the last 2 years, or $300,000 with a spouse, and has a reasonable expectation of making the same this year. That's accredited investor territory. Qualified clients, double that for net worth. So 2.1 million actually. So it's a much higher standard of a client. And again, this is state by state and it's kind of confusing, but just assume you're going to have a lot more sort of red tape to deal with in hedge fund world if you're trading securities. And that's this money management piece. It has nothing to do with founder formation, nothing to do with securities offering. Okay? Securities offering, you might be able to just take in accredited investors, that's fine, you complied. But over here in money management, if in order to not be regulated as a full-on registered investment advisor, which means you need to pass your, I guess it's Series 65 and 7 or just 66. I mean, there's two that are separate and then there's one that covers both, but it's, a bunch of licensing and tests and stuff like that. In order not to have to do that, you're going to need to find an exemption. And if you're not a private equity fund or a venture capital fund, those exemptions can be pretty hard to find. So in Texas, the way you get it is to only have qualified clients. So again, it helps to kind of compartmentalize this whole thing into three big buckets and to keep that securities offering separate from the money management advisor piece. And if you want to be a true crypto asset hedge fund, at least as the time I'm recording this, you can avoid a lot of this altogether. It really can be pretty simple. For that whole package, you can expect to pay, big law, 60, 70 grand. You could expect to pay someone like me less than half that, but it's still a whole lot of work, and it's going to take you a few weeks at the very least. And if there's a licensing piece, obviously that's a gating item, and that's a whole lot of work too. But generally, if you could stay in crypto asset space, it's quicker and it's faster. You can be up and out there in about 3 weeks. There's custody issues. There's some other stuff. You need some policies, but that's the broad scope of what goes into forming a crypto asset hedge fund. So if you have any questions about any of this, any feedback, anything I didn't touch on that you'd like me to say more about, send me an email, drop me a line, put a note underneath the video. If you liked it, tell me that. Appreciate you listening today.